Okay, folks, good morning. Let's go ahead and get airborne with our advanced live trade brief this morning. Just a quick intro out of me. I saw this on Facebook last night. I thought this was hilarious. If you guys are hockey fans, I was obviously an Adam West fan. So when obviously the original Batman and probably one of the only best Batmen. So I saw this the other night, and obviously if you're a hockey fan, you think this is pretty funny. So I thought that's our chuckle of the morning. Everybody have a good time last night with Doug, who got to attend his vertical spread trading. Great session. A lot of great questions. I sat there and watched all the questions, interacted with a lot of you. I think we 4 or 5 slots went during the session last night, and a good time was had by all. Yep, I will give you that link right now. It's in the chat box, but if you didn't attend, there is the replay page. Everything we've done this week is on this page. I know one of my strategic partners last night emailed, so I think we might even have a whole new couple hundred new people in this room today. So for all the new people, thanks, Lloyd. It was outstanding. And Doug just ain't acting last night. That's when you grab your full throttle slot. Those are that's the type of training you're going to get either from me or from Doug during whenever we teach any of our sessions, folks. So there we are. There's all the replays from the week. You can grab your full throttle slot by just clicking on one of the blue buttons on the replay page, or you can head to go.topgunoptions.com/ft-now. Okay. Yes, he is an excellent instructor there, Ralph. Appreciate the kind words. So, and you're going to see that lot. So last night he was demonstrating a tactic, and now he's going to do. I know he's got a couple trades lined up that he'll talk to you about. I'm not going to let you know a little bit early, but here's our slots, and I think it never fails, folks. As soon as I get on the air here, my phone buzzes, and I have it set up. So I think that's 22. I will update it by the end of Doug's session, exactly how many slots we have. It seems like people actually watch and then go, okay, that did it, and then they grab their slot. We will be filled by tomorrow afternoon. Historically, right now, we're a little bit ahead of our fill curve. There's an initial rush of people Wednesday as soon as I open the door, and you know who those... let me share with you historically. So the people when I opened the doors Wednesday afternoon after accelerated retirement, you know who those like 11 or 12 people were? Anybody take a guess? They were the people, the last full throttle in, what was it, March, April, who didn't get one of the slots, who called us up and said, no, really, no, you're number 55 who called up, as a matter of fact. So we said no to the last 4 people, and it's no to you. So those go really quick, and then the same thing will happen Friday afternoon or whenever. Monday, you give us a call and go, okay, now I'm ready. And then we say, well, you're going to have to wait a couple months for the next full throttle. So we're not kidding. As soon as we hit our 50, we're closed. Good morning. Welcome to the Advanced Live Trade Brief. Doug is going to be taking over here in a couple minutes. We've knocked out a hell of a week, folks. Like I said, if you haven't felt like you've been drinking from a fire hose during this week, we haven't done our job. If you're sitting here going nice and comfortable and yay, that ain't the way you should feel. You airdropped in the middle of Doug and I conducting our flight operations, and trading's a form of combat. So if you don't feel like holy crap, these guys are hitting it pretty hard, we didn't do our job. So I've done my job through last night. It's Doug's turn today, and then tomorrow Doug and I will knock out a quick debrief at 1 o'clock from about 1 to 1:30, and then I'm going to knock out our weekly options brief and talk about weekly options, what they are, how tactical they are, how great they can be, and how sucky they can be if they're going against you. So it's it's a very, very tactical trade, weekly options. And the weekly bull put spread that I sent out on Monday afternoon, I know some of my members are still in it, could potentially expire this afternoon for a $700 profit. Raise your hand. That almost pays for an annual defensive slot worth 1 weekly options trade. Raise your hand if you wouldn't mind a trade on Monday paying for your annual membership, 1 trade this week. Exactly. Yep, there's a lot of hands going up, and that's exactly what happened. I showed you some of our testimonials where a lot of people said, hey man, I paid for a couple annual memberships with, I mean, hell, we have people in Goldman Sachs trades up $130,000, $140,000 on 1 trade in Goldman Sachs who bought lifetime memberships recently. So folks, this is men lie, numbers don't. So Doug and I are showing you this stuff. We ain't hiding behind a curtain and saying, hey, look how great we are. We go out here and show you. So this morning I gave you a slot update. The Wiz and Doug debrief will be tomorrow, as I said. I'll cover some quick administrative items. I just told you the remaining flight schedule. Doug right now, Doug will send out an ATA as well, the Advanced Trade Alert. He'll actually make the post public and share it with you so you guys can see it and see what the member pages look like, which is pretty cool. I gave you the slot link, and then I'm going to intro Doug and get out of his way, okay? Hopefully you're feeling this way right now. I'm getting a lot of good vertical head nods. Saw a lot of comments last night. Hey, Wiz, one guy told me I wanted to grab a screenshot, and I was putting Keely to bed, who said, hey, man, you're right. I do feel like you guys treat options trading like combat. When Doug was in the Army and I was in the Navy, Army-Navy game, why would you not treat your trading with something as much of an urgency as your freaking life? Or why wouldn't you at least use those procedures? How stupid is it? When you think about it, folks, combat uses the most precious capital you have, you, or our nation has. So why don't you learn and trade at a place where we actually use those methodologies with pretty great success? Okay, you guys know me. My background: ran Peak 6, ran the Options News Network, and then my squadron commander. You guys met Doug last night. He's the advanced instructor, full throttle instructor, and wingman group coaching, a Vol Arb guy, egghead quant, half techie, half trader, half superhuman man, and good father. 500 million a day in trades. Director of European trading down the street from me up in Chi-Town, and he runs a small private equity fund down here in Florida, which you can always reach out to him offline to talk about it. So you got to see what our flight schedule looks like. You got invited to attend everything the way it normally is. The only thing that we moved this week was weekly options. It's usually Monday at 1. Makes sense, right? Wiz puts on trades Monday and manages them during the week. I still sent out my trade, but I was doing something else. I was doing a timing research trader roundtable. So that's the only quirky thing that you didn't see. Doug is, I think he's got a couple cool earnings trades and loves trading volatility, okay? So he's going to show you how he manages risk, tries to bail out of trades for min-loss, and obviously knock it out of the park for maximum gains, okay? So if you guys don't have any questions for me, as Doug's talking, like one of the reasons, folks, and I answered this repeatedly last night to people, is we only take 50 because even Doug last night, he's like, holy crap, look at all this good stuff flying by. That's not how we trade live. I showed you our screen the other day. We have like 6,700 people registered for Full Throttle Week. When we have a zoo in here, we can't answer all of your questions. That's why we only take 50, and that's why we only do full throttles every couple months, every 3-4 months, as people atrophy and say, hey, Wiz, been here a couple years, time to go head out to the fleet on my own. We love that because those are actually great testimonials and they recruit people. Two of the guys at our Miami event, Fish is probably in here. Fish has been here for like 4 years. He recruited those two guys. They all work at FedEx. And then the two guys who Fish recruited one of their buddies who we all had drinks down here at the Boca Hotel. So you guys pay it forward. So we don't mind when people leave actually because it's very, very rarely because they didn't like it here. Okay. So I'm going to get out of Doug's way, but I will be here to provide him mutual support in the chat box and the questions. If you guys have anything, the guy's a hell of a lot smarter than I am. So if it's a legit trading question that Doug needs to answer, he's going to do it. Okay. So Doug, I'll tell you what, my friend, over to you. I'll get out of your way, and then I'll be on at the end to update folks as far as slots because I know some will go during the sessions here. So over to you, my friend.
Hey, thanks. Good morning, everybody. You see here, don't normally do this, but here goes the camera. And let's get a screen. Okay. Hey, welcome to all the new people. Welcome to the people visiting us and checking us out. And also, welcome to all of my regular people. For everybody who's new here, I just want to give you a little heads up. The group that is with me on a regular basis and they've built up over the years is an outstanding group. It's a lot of fun. We fight, we argue, we laugh, we have a great time. It's kind of like a family at times. And it's always good to see him. I was actually just chatting with Richard a second ago. Richard and I had a little back and forth on a VIX trade. Richard won that argument, actually. So I'm giving points to Richard on that one. But these guys are here on a regular basis, and men and women here on a regular basis, and we have a great session. So today's session is going to be pretty much what we do all the time. I'm going to modify it just slightly because we've got so many new people in here. I'm going to trim down the review of the old trades a little bit, focus on some new trades mostly. A couple of things that we want to be paying attention to right off the bat is what is going on in the world, because that's the stuff that we need to at least have an understanding of the background so that we know the context of our trades. You don't trade in a vacuum. Nobody trades in a vacuum. And the fact is, trading is not numbers. Trading is not a squiggly line. Trading is a bunch of people in the world making decisions. And those decisions are a conflict of the most optimistic people versus the most pessimistic people. We got to have a good idea of what's driving that decision-making process out there. We also have to have a good idea of what's going to feed people numbers and make them want to trade in different ways. So we're going to handle a quick little market overview at this point, just hitting some of the high points and things that I'm seeing out there. Then we're going to go into, I am hoping, we get some work to do today, but I'm hoping to nail down 3 new trades this morning. Going to be looking at the SPY, UNH, and WYNN, and we may branch off. I'm not guaranteeing you're going to stick to the game plan exactly, because we pretty much get driven by what's going on in the markets. But just before we get going, I do want for all the regulars here to cover a little bit of what we've got. We actually closed out a bunch of trades last week. We're left with a pretty thin book, to be honest, and we've got to fix that. Hold on here. Main trades we have on right now, we have a SPY iron condor. We are currently waiting, and get very close actually, to closing out. This is an extremely long-term iron condor going all the way out to September, but we're using the time to basically capture some profits as the SPY moves up and down. And we are well on track for nailing, closing out the bull put spread on that one. So we're going to be keeping an eye on that. It's not ready yet, but coming along soon. Second one, and this actually applies to all the new people too, we hedge. We want to make sure that we're not doing anything dumb. And the fact is, there are things in the market you cannot control. Don't ever believe that you control the market. We're using the market, we're riding the market. It's like surfing. You know, you've got a wave coming in, you ride the wave. That doesn't mean there can't be some weird rogue wave come along and knock you off your board. So we hedge. That's what this is about right here. One of them is going to expire tomorrow. That's perfectly fine. This is a VXX bull call hedge. It's cheap. This right here costs us about $400. $400. It's going to cover me for the next month and a half or so at this point, and it will prevent me from losing about $6,000 if the market comes correcting down. Extremely important. I'm not going to add one today because I've already got one on there, but just know that that's something you need to be paying attention to. It's not about making a big win. It's about keeping money in your pocket. All right, a couple of things. Big picture. What do we got going on? Yay, a face. Glenn, are you sure you want to say that? Hey, Graham, good morning. Well, actually, what, middle of the night for you, isn't it, Graham? You're standing upside down on the other side of the world from me, unless you're over here again. Yeah, here's my face, everybody. You know how rare this is that I actually put a camera on? And it's really for the safety of the children out there. I have a classic face for radio. I feel like how Howard Stern must have felt when he first started getting on video. The guy's not a pretty guy. But, hey, I can talk and I can trade, so let's move. Going on in the market. Fact is, no matter what we think might happen, could happen, should happen, whatever, and there's a ton of reasons to think that the market could come crashing down any minute. The fact is, the market's been going up. It is what it is. It's doing what it's doing. And I really encourage people to not try to be too fancy about predicting what's going to happen next and just work with what is happening now. Doesn't mean we're going to be stupid about things. Doesn't mean we're not going to look at risks. Doesn't mean that we're going to be, putting trades on that are super risky and 100% biased in one direction. But it does mean that we work with what we have now. And what we have now is the market in a bullish run. Now, is it going to end? Absolutely. When's it going to end? No idea. That's the problem. Statistically, though, and this isn't something I'm making up, this is a well-known fact in the market, you know what's most likely to happen tomorrow in the next couple of days? Something very, very similar to what's been happening over the last week or two. Statistically, that is your advantage. So we're going to work with it. In a few minutes, we're going to take a look at SPY, but that doesn't mean we can't be aware of all of the, all of the craziness and all of the warning signs that we've got out there that could actually hurt us. So let's run down through that real quick. Not grouchy today. No, Joseph, I am not. I've had my coffee this morning. Come on, Joseph. Actually, Joseph, you're moderately new to us. For those of you who've been here for years, actually Graham can attest to this. Out of the years that you've been here, Graham, how many days have I been grouchy? I was grouchy one day. I'm a trader. You should see how grouchy some traders get. All right, let's take a look. Well, thank you, Graham. Quick little run through on big picture stuff. For those of you who are new here, let me hand you off some interesting little links that may be useful to you. I love this one, VIX Central, because it tells me a lot. Everybody has some skepticism, some criticism, some arguments about news and the information that we're receiving on a daily basis out in the world. And the fact is, every bit of news that we get is biased in some way. It's a fact. It's because it's given to us by people. And those people have thoughts and ideas that they want to push, and okay, that's what the world is. So what we need to do is we need to find sources of information that are independent of that. And you know what I trust? More than I trust somebody jumping up on CNBC and saying that the market's going to go to 150,000, 200,000, whatever. What I trust is people trading, because these are people putting their money down on what they believe is going to happen. So here we are, VIX Central. What does this do? It shows me the pricing of futures contracts in the VIX market. Now, what does this mean, and why is it important to me? Because it gives me a picture of how much premium they're pumping into the futures contracts in the future above and beyond what the implied volatility is today. It gives me a picture of what actual traders putting their money down think volatility will be in the near future. Now, you can't look at this in a vacuum. This is something I'd actually encourage people to take a look at every single day. Just touch it once a day. And I can see that the futures market is pricing in the VIX at 1205, expiring in 5 days. This is the June futures contract. This is actual people putting money down on this stuff. Now, what's interesting about this is there's not a lot of time between now and when this expires, but they're basically pricing in just barely of where we are now, which means that they don't actually see a whole lot of really crazy volatility in the next couple of days. They're not seeing a huge risk premium. But go out a little further to July, they've built in a bit more. Now, I'm going to say this. This is actually one of the least elevated premiums on futures that I've seen. So this is actually a relative sign of optimism out there. You have to see this on a daily basis and get a feel for it. But we're looking at the backwardation on this one, or excuse me, the contango effect on this one. It's very, very minimal, and it's basically pricing in very, very little extra volatility over the next month or so. And really not even all too much going out to August. So I just got a little perspective here. People putting their money down, trading and believing in what's going to happen are not elevating the VIX futures substantially. They're a bit, but you should see when it gets bad. You should see when it gets crazy out there. You'll see a huge gap between where VIX is and the futures contracts. And you'll get a sense that people are very, very anxious about the future. Now, a couple of other big drivers that are going on in the market. Obviously, we had a rate increase yesterday or the other day on the Fed. Knew it was coming, no big deal there. It's pretty much a given. The Fed is going to be raising interest rates. To be honest with you, I don't care about that. It's baked into the market. Everybody knows it's happening. Everybody knows what's going on. So what are some of the things that really could mess the market up? This one, the Fed Reserve balance sheet. Now, this is the big news that came out. The Fed has, what is it here, 4.4 trillion, big T trillion dollars in assets. And what the heck are these things? These are mortgage-backed securities. These are treasury notes. These were all things that were bought from the banks when the banks were basically in the bottom of the pits, and they were bailing them all out. So to bail them out and to get their balance sheets back to a safe level, they bought up all these assets. The Fed now owns this stuff. This all happened, quantitative easing right here. Boom. before that, the Fed barely had a significant level of assets. Now we're up to 4.4 trillion or 4.46 trillion. They need to get rid of that. That is not something they want to hold on to. And they're waiting and waiting and waiting for the chance to do that. Now, as they dump those, which they are basically predicting to be doing as the end of the year approaches, what's going to happen? Prices on all those styles of assets, treasury notes, mortgage-backed securities, all of the interest rate products across the board, the prices on them are going to be depressed. The yields are going to go up. As yields go up, they become attractive for safety money. Safety money is your Saudis, your Harvard pension funds, your Yale foundations, your CalPERS, your big, huge chunks of money that just want to stay ahead of inflation and do not want to be taking risks on market crashes. Right now, the U.S. equities market has a huge amount of what I would call inappropriate money in it. Now, I love it. It's great. It's good to have that money in the market because it's been one of the things that's helped push us up. But that money can move, and it can move fast at times. As it does, as it shifts, more yield over on the bond side, less attractiveness in the high-risk assets in the stock side, you're going to see money shift out of the stock market into bonds, into different safety assets. I'm not saying that you and I are going to be the ones doing it. I'm saying that the boring, super controlled funds are the ones doing it. We could see a risk of a shift there, and that could have a dramatic effect in the market. Is it going to happen tomorrow? No. Do we need to be aware of what's going on so that we don't do something, absurd and stupid and put every cent that we've got in bullish trades? Yes. So there's indicator number one that I want to be paying attention to. And I am going to be looking at this line to see when it starts dipping. You're going to see two things. One, prices on treasuries and different assets in the interest rates going down, basically pushing yields up. And two, this dipping a little bit. Those two going coincidentally or simultaneously is going to basically be the sign that Fed is dumping its assets. They will not tell us in advance. They'll kind of give us a little heads up that maybe it's going to happen someday, but they are not going to sit there and tell us the day it's going to happen. Number two, let me see. Number two, this is one people don't look at too much, but it's interesting to me. It's actually the flip side of that Fed balance sheet. Because back here in 2008, simultaneously to the Fed balance sheet going up, by the way, this was them buying assets, and this was the money from those assets going into the banks. This is what's called excess reserves. Now, why does this matter to me? Because this right here is a huge stimulus package, if it ever gets used. This is $2.7 trillion at this point that was sitting in banks that is above and beyond what they need to have to actually function as a bank. Now, these banks get a little tiny fractional interest rate on this. I think, actually, as of yesterday, it probably bumped up to 1% per year. But hey, 1% per year on no risk, $2.6 trillion or billion dollars. Heck, that's actually no, that's not. Yeah, 2.6 trillion. Man, I gotta get my big numbers right. That's a lot of interest. Now, there's an interesting thing that happens here. All of this money is money that the banks, if they chose, could 100% legitimately loan out and make more money on it. Now, that right there is an interesting, that right there is a really, really interesting thought because they have two choices. Loan that money with the intent of making more money, or keep the money in their accounts because they think it's safer and a better bet to make money off of the Fed giving them free money. Now, let's look at the reality. Chase, JP Morgan Chase, has one of the biggest excess reserve accounts out there. They have a tiny office of a handful of people that manages that, and it nets them billions of dollars a year in interest. Compared to how many bank branches are there out there? How many loan officers? How expensive is that? Well, they need to make some really good money off of loans, safe loans, to beat that out because safe guaranteed money versus a bit risky, more work for it money. Now, that money going out is directly put into use in the economy. It is a nice, solid stimulus. So we want to see this line going down. This is what's bothered me recently. Hold on. This bump right here. We had gotten that excess reserve account back end of the year down to $1.8 trillion. Since the beginning of the year, it has gone up and peaked out at 2.4. Now, or 2.24. This is just shy of $500 billion. Now, the only way that this could have happened right here is if people were paying their loans, which is wonderful, and the banks were not putting out loans. Now, I'm really curious to see what's going to happen in the near future. But if the banks, so this is basically banks taking in receipts and not putting loans out in turn. This means that money's not moving into the economy. Now, the big question I have is why do the banks think it's better to hold on to that money right now than to loan it out? Seen some good arguments. Maybe they're just keeping their powder dry, waiting for the right opportunity with rates going up to lend it out at a higher rate. Possibly a legitimate answer to that question. But this is an awful lot of time to wait, sitting on money, waiting for interest rates to go up. And that is a lot of money. It's literally $500 billion that did not flow into the economy over that period of time. It went backwards. So, mystery, I don't have the answer. I'm paying attention because it is a direct economic indicator, basically feet on the ground of people deciding what to do with money. And I would really like to see this line start coming down. That would give me a lot of confidence that we've got some form of economic boost coming along and that there's people using money well out there. All right, so that right there is some of the big picture stuff. Today's number is the jobless claims, 237,000. We are doing outstanding on that. Jobless claims have been running great. It's ticking up a little bit. I mean, to be honest with you, we're at such a low anyhow, I wouldn't be surprised to see a bit of a tick up. We've got a ways to go before the new non-farm payroll, so no major issues there. What do I see out there? Beyond that, we've got extremely high P/E ratios. We've got valuations that are excessively high, depending on how you look at it, whether it's Shiller P/E, whether it's regular P/E, whether it's half a dozen other ways of looking at it. But valuations in the market are very high. Long and the short, we are probably going to maintain our bullish trend, but when and if we do drop, we've got some room to drop down quite a bit. We need to be careful. We need to be watching out for that. I do not believe that we're going to have anything horrible happen in the near future. I think we've got a good solid trend and there's nothing major moving the markets around. But we did get some warning signs last Friday on the tech market. Your Amazons, Nvidias, all the tech market got blasted in a flash pullback, flash swing up and down. That right there is an indication of risk. That's saying that people are basically ready to jump, on a moment's notice if they see things failing. So keep an eye out for that. Now let's get into some trades. 1.25 interest on 5 billion. No, it's the numbers were trillion, and the interest rate is, I believe, 1% right now on that excess reserves. So here, what would you get for? God, we're gonna have lots of zeros on this one. Currently 1.7 trillion. So here we are with thousands. There we are with millions. There we are with billions. There we are with trillions times 0.01. Yeah, I'll take that as a free paycheck. That's money that the Federal Reserve basically pumped into the banks. So not every bank is going to get $17 billion in boost, but every bank has an excess reserve account has a share of that. So that is not an insignificant amount of money. Some of the biggest players in that, by the way, Bank of America, Deutsche Bank, strangely enough, has got one of the biggest excess reserves. JP Morgan Chase, Wells Fargo, pretty much your big players out there. And they've got huge, huge excess reserve accounts. All right, market-wise, we are pulling back a little bit this morning. Yep, and additional interest waiting for the balloons to go out. Exactly. Oh, you meant to highlight the 0.25% Fed hike yesterday. Absolutely, you're right. Yeah, that was a little boost. Every time they do that Fed hike, they also increase the rate on the excess reserves. They go hand in hand. So yeah, you're absolutely right. They just got a little, 0.25% bonus, which would be, let's see here. So the move yesterday by the Fed only added $4.25 billion, billion dollars to that pot. Next time they do it, Fed adds more. All right, let's take a look at some trades. Now, we have some interesting challenges out there. Let's take a look. We are down a little bit, actually a little bit of a big move this morning. Nothing huge, but we are, oh, there we go. Hold on. Got to check on that. We had an order in last night on an NVIDIA trade that just got filled this morning, literally just in front of us. Let's take care of that fast. Okay, I'm going to try to do two things at once now, which is not always the best, but so, by the way, for those of you in our NVIDIA session last night, I put out a trade on NVIDIA that was a bull put spread 133 by 136. I ended up sizing that out to 25 contracts, and sorry everybody, but I have to, for all the members here, I have to get the alert out right this moment. This takes one moment. Okay. And I got filled for a 67-cent credit on that one. By the way, for anyone who's new, what happens here is as the trade happens, I'm sending out an alert as it gets filled. That alert goes out to everybody. It's quick, it's simple, it just has the basic information about the trade. After I'm done these sessions, I am sorry, but I'm human. I can't type and I can't type and talk at the same time too well. I try sometimes, but it's not always successful. I do a full breakdown of the trade. What is our, what is our stop losses? What are all the limits? Basically, everything. And that is a full rundown and a full analysis of the trade, but you're going to get that after the fact. And hold on, I'm almost finished. So that NVIDIA trade from last night just got filled. One more. All right. Especially during sessions, these alerts tend to be pretty brief. Okay. They are off, absolutely. Can I explain what's happening with the SPY? People are trading it up and down. Let me see here. Ken, what inspiration? I'm not sure what that word is. You're not allowed to make up words on me. What's the inspiration on the NVIDIA trade? The NVIDIA trade is basically built off of two things. One, an overall longer-term trend, which we're basically working off of. But two, the fact that the increase in implied volatility from some recent activity in NVIDIA gave us the opportunity to take a short volatility trade that was also directional basically in this market. I'm not saying that NVIDIA may not pull back. I'm saying that the pricing on the NVIDIA trade was so solid and so high that it gave us lots of room to create a trade for profit. We can make money in two ways in this one. One, volatility IV on this NVIDIA drops, which is actually very, very likely to happen. And two, it either stays stagnant or moves up a little bit. Combination of those should give us the opportunity to close out the trade in a reasonably, I'm guessing 2 to 3 weeks, shooting for about a 50 cent profit out of our total 67 cents of credit on the trade. Closing the trade down early, basically turning our money over faster. Inventory turnover is a beautiful thing in trading. So that is what I'm working on for a philosophy on that trade. I will write that whole thing up after the session. So let's move on at this point, and let's take a look at SPY. Now, today's price movement might throw a little bit of a kink in the works here. I hope not. We'll see. SPY has been on a tear. You can't really deny it. It's basically what is going on the SPY. So it's been going up and up and up. Now, what's interesting about the SPY at this point is that we also have excessively low implied volatilities. Not just today's 10.3, but taking a look at the actual options themselves. Some of these options are just absolutely absurdly low. Let me check something out. I had okay, where did that go? All right. My trade in the SPY just got wiped out. No big deal. So here we are. We're looking at the actual options on the SPYs. And we're seeing implied volatilities about 10.4, 10.8, 10 point. Anyhow, these implied volatilities, especially on the call side, are literally crazy low. In fact, this is, I'm going to point this out. Notice how we've got some really big disparities in the implied volatilities on the calls versus the puts. This is a hard thing to come by. This is really on the edge of an arbitrage, to be honest. I want to check the numbers on here. It gives us an interesting opportunity. Because the implied volatilities over here are so low, we can play an interesting little game on this. So let's dive in and actually start playing this. This is getting into not just directional, not just picking out where the market's going to go, but also playing with the implied volatilities to figure out where you're going to be able to get some of your absolute best opportunities and leverage the opportunities in a good way. If I take a look at the charts over here, you keep getting emails about dividends. Dividends are good. Dividends are yield. That will help hold the dividend-producing stocks up, Silvana. I guess it's the topic of the moment. I'm not really sure. All right. Short-term directionally, what are we looking at in the SPY? The SPY has been on an extremely strong bullish run. Too strong, in my opinion. I think eventually it's going to fail. But do I think it's going to fail tomorrow? Probably not. Do I think it's going to fail next week? Probably not. 2 weeks? Don't know. Here's the honest truth. I can't predict the top. Markets have the ability to go on and on and on. But even if they're in an excessively risky spot, what I've got now, though, is a market that's going up and up and up, and it's got excessively low implied volatility, which is a little backwards. So I'm just going to take a look at this, and I'm going to look and extend this out into the future a bit. And over the next 2 to 3 weeks, where do I think the SPY is heading in general? If it stays along the general path it's been on, let's see, on the 7th of July, we are looking to hit a level of roughly 247. Now, is it going to exactly hit that? Probably not. Could it hit a little less than that? What are the odds? I don't know. I want to make something here. I want to create a target for the SPY going up that I consider reasonable, that I consider possible. This right here is crossing over at about 247.50, 247.72. For right now, I'm going to make the assumption that we've got a pretty decent chance over the next 3 weeks, or between now and the 7th of July, that the SPY is going to go above 247 or pass through 247. So, how many of you were here last night for the vertical spreads trading? Anybody? I assume a bunch of you. We talked about doing vertical spreads, bull put spreads. And I made a point last night that bull put spreads, vertical spreads are good in certain conditions. Moderate to higher IV, lots of premium, especially when the premium is significantly higher than the historical, or the volatility is significantly higher than the historical volatility, gives you extra edge, all of those things. I also said that it's not appropriate for certain times. One of those times is when the market is at when the options in a symbol are at an extremely low level of implied volatility. You just don't want to take a vertical spread in those situations. What happens is the strikes that you're going to take on a vertical spread, a bull put spread, are going to be way too close to the price of the stock. The stock didn't necessarily change the way it moves. The risk is still high. You are not getting paid very much for the level of risk you're taking. Therefore, vertical spreads would not be a good idea on the SPY right now. But there are other trades that we can do that actually work out very well. So let's play with this one. Right now, I am going to target roughly 3 weeks out, or I'm going to target the July 7th, 22 days, and I am going to be looking at a strike somewhere around, actually, I'm going to go inside of the 247. In fact, I might even drop down to about 246. I want a number that I can be pretty comfortable that the SPY is going to be approaching. It's got a good chance of hitting. I don't want it too far away. I could even go a little bit lower on this one if I wanted to really play it safe. And I'm going to sell short on this one. Now, let me point out a couple of things that are driving some of my decisions about this trade. The implied volatility on SPY right now on this call is 5%. That is not just low, that is ludicrously low. Okay? I mean, literally ludicrously low. That also means that I'm not going to get a huge amount of credit, but I'm going to fix that in just a second. So I'm actually going to shoot for a much lower number, 245.50. And I'm assuming that between now and 3 weeks from now, we are likely to see SPY move up through 245.50. Selling it for about 35 cents. Now, I'm not going to do a naked short. That would just be nuts. I'm going to be going about 2, maybe 3 weeks past that. I can't use the monthlies, but I should be able to use the true. I keep forgetting I've got so many expirations in these things right now. 22, 27. Okay, here's 1 week past. There's 2 weeks past. Hold on. It's actually going to be 3 weeks past. We can still work with that. Hold on. There we go. Now, I'm going to go long on this one. Okay. I just created a trade with a $1.29 debit. Now, I'm going to probably end up playing around with this a little bit. Hold on here. That is wrong. I want 245.50. 86-cent debit. There we go. This is a very, very standard calendar trade. So let's take a look at it from the point of view of just a pure calendar trade. And once again, I might play around with the expirations on this a little bit, just moving around to try to get some different features. But if I took this trade right now, and if implied volatility does not change in any way at all, if we have the SPY moving up, we have a potential for a fairly significant win here. But more what I want to take a look at is the fact that over the short term, I can get a very, very solid win just by paying attention to when the SPY goes by 245.50. Now, this is looking at this as of today. So if today I moved from where we are up to close to 245.50. I don't expect this to happen today, by the way. I'd be making let's just say 170 bucks on an $870 trade. Now, let's just take a look at some of the numbers on this and see what that actually means. That right there is a 19% return on my trade if I just moved up towards 245.50 in SPY. Now, that's starting off today, and that is my baseline on this trade. I am not, just because I'm taking these options that expire off in, let's see, the 7th of July, does not mean that I'm going to hold on to this trade that entire time. As time passes on this trade, we are concentrating this profit in the peak. It's going up, a little bit of time passing here, and we start to make more and more money. Here we are on the 30th. So we're basically 2 weeks into the future. We could be making about $260 on that same $870. So if we hit 245.50 at that point, we're making 31%. Now I'm trying to get a little sense of where this trade is going. And by the way, we may change the expirations, we may change the strikes a little bit too. But I want to get a big picture view of this. But this isn't the whole picture to this trade. Now, this is where I want to show you why this becomes interesting to me. And as I said, we may shift our strikes around a little bit. If the market starts going down, takes a big drop, maybe even not a big drop, maybe just a couple of % drop, what's going to happen to implied volatility in the market? Quick little question to the crowd here. What will happen to the implied volatility of SPY if the market starts dropping even moderately, 1%, 2%, up? Let's go take a look. Historically, let's see, what happened on this day right here? The market did this little move, and this was, it's a fairly decent move in the market, but it was not an outrageous move. Well, implied volatility went from where it was, down here around 10, actually pretty darn close to where we are right now, up to about 16.5 on the SPYs. It's a big jump. Now, the trade that we're working with, we're starting off with the options specifically on the call side because these ones are giving us an extremely low implied volatility. These will go up also. They can't diverge too far from the puts because you've got put-call parity and that's going to cause an arbitrage. They can't vary too much. So if the market goes up in implied volatility, and remember, we just looked at a market drop and it jumped up to about 16. This right here is going to go up. Now, I'm not going to get too optimistic on this, but I do believe that these implied volatilities could pretty easily jump up to 13% IV with almost no major issue happening, just a few % move in the market. So what happens to my trade? And this is where the calls come in. This is actually where the calendar spread, the calendars come in. This is where the calendar spread becomes very, very different in this market than in other markets. Going back over to the Analyze. Okay, remember this. We are on the 30th. I'm hypothetically saying that we have a market pullback somewhere around here. Maybe we've moved up. Maybe we've moved down. I don't know. But we were somewhere in the middle of this, and we get a nice little bump in implied volatility. Our IV on these ones right now is, let's just call it 6.25. My expectation is that these are going to shoot up to about 12, 12.5. I'm just going to add a really, really basic 6% implied volatility. This is not outrageous by any means. Now, as I press the button, pay attention to the Pnl curve. And this is where volatility comes into play. This is what's going to drive my decision about this trade. There. That is not an outrageous change in implied volatility. That is just bringing the SPYs back to a moderately normal level of implied volatility. 12% implied volatility on the SPYs is not outrageous, especially if we're in the middle of a little bit of a price move. What happened is the long option that's part of this calendar has a huge effect from volatility going up, and it increases the value of the trade. We would have just lost, by the way, on the short side of that trade, but that's irrelevant because the short side wasn't going to lose that much. The long side of the trade, on the other hand, was going to make a ton of money. Now, what does this mean for the trade? And why does this kind of drive my decision-making about this trade? If I believe that I can make money on this trade from the SPY going up and heading towards 245.50, which is a pretty reasonable target. Let's actually draw a line in here. I just want to show you that this is not an outrageous level to actually hit. And here, we'll even trim the time frame down a little bit. Given the overall long-term trend we've been in, do you think it's reasonable that we can get from here to this green line between now and the expiration of our short option on the 7th? That's the biggest question you've got. Do you think it's a reasonable expectation that we can get from here to here between now and this line right here? If the answer is yes, if you believe that overall it's possible, if you believe there's a decent probability of that, all by itself with no implied volatility change, this is an excellent trade. We could be making 20, 30, later on in the trade, we could even be making more money, 40, 50. What's the peak on this thing? You don't really want to look at it as the peak because bluntly, we're not going to make $750 on this $870 trade. It's just too hard to hit it. I would actually put a much more reasonable profit target in and let us move through that target if we want. But it gives us plenty of room. That's what, an 80% return on the trade right there? I'd have to take a look. That's the range of possibility we have if we have no change in implied volatility. If we do have a change in implied volatility, the game radically changes. We are looking still at an $870 cost, and the peak up here is actually $2,100. Now, practically, what does this mean for the trade? We're not going to get an IV spike if the stock goes up, but we're making money anyhow if the stock goes up. If SPY keeps moving up in the direction we want, as it hits 245 or 245.50, we are making a good profit, excellent. I mean, who here would be happy with 20% or 30% over 3 weeks? I hope that's a reasonable, profit target because that's it's pretty good money over a short period of time. If the market starts moving against us, how's the trade going to fail? The implied volatility in the market's going to go up. It's going to push up the profitability of the trade. It's going to drive our break-even point way down, and it's going to make it a lot easier for us to be safe in this trade. It's going to give us a graceful failure and potentially, depending on how the implied volatility moves, if it moves real quick, it could actually hit a profit target we have and get us out even as things start shifting against us. So I've got a trade that can win in one way, just by moving the way the market's supposed to be moving, and a trade that's going to protect us or potentially win in another way if volatility shifts. Both of these are opportunities for me, and I'm lining up the trade with what the market can do and how the market could potentially make me money. So, quick questions. Anybody like? How often on IV or SPY up? Actually, here, Jim, I'd ask you this. How often has the implied volatility on the options we're trading, which is about 6%, how often has that happened historically? By the way, this right here, this green line, is an aggregated IV, which means it's just a measured IV across a whole bunch of expirations and a whole bunch of strikes. But this is the average that we've got right here, and this is the SPY going back in history. Here's a line. Now, I've just averaged my long option and my short option. It comes out to about 6%. Right about where my cursor is. That is the implied volatility in the options we are holding compared to what the lowest lows on the average implied volatility on the SPY has been, which really is almost never on average below about 10. There's a very good chance. And it won't take much. Fear, uncertainty, and doubt. It's all it's going to take. A little bit of a bump and fear, uncertainty, and doubt in the market, and we will have a movement in the implied volatility. But what I want to make a point of is the trade itself does not need that to work. If we put a reasonable profit target in on this, and we have a decent little price movement of just what the market has been doing, not asking it to do anything new or anything special, just moving up towards 245.50, which is that line right there, we will make a profit on this trade with no change in implied volatility. If the market starts pulling back against us in any way, if the market starts getting a little upset, nervous, implied volatility goes up, which would hurt our trade and cause us to fail, that IV is going to boost up the trade, protect us, and reduce the risk. Potentially, and I don't want to give you too much excitement on this, it could cause us to hit a profit target and exit the trade if the IV goes up quick enough before there's a major market move itself. I'm not going to bank on that, but it will help us out a lot of ways. So, number one question, do we believe it's possible to hit 245.50 between now and July 7th? My vote on that is yes. I'll take any inputs. Patrick, if the SPY goes back up, the VIX will drop quick, fast. Wrong. Can VIX, VIX, but we're not trading VIX. Remember that. We are trading SPY options. And specifically, I'm trading the call options, which have a current implied volatility of about, on these ones, 7.5. There's a floor to volatility. And yes, as markets and stocks go up, their volatility tends to drop. But that is not true forever, because volatility cannot go to zero. And volatility will not go below what is considered to be a fundamental bottom for the options traders. They don't want to put out a trade that they're not getting paid well enough to take the risk. And the fact is, the SPY is still going to move around. They're not going to put out trades that are going to expose them to too much risk with no payment. So you get to a very bottom floor. Now, if I was trading this and the IV on these was 12, you would have a very, very good point, and I would be worried about that. Could the implied volatility drop on this a little bit? Yeah, very little. There's not much room for this to drop. And if it's dropping, the price movement is going in the direction we want. We're probably still heading towards a profit. So I'm not that worried about that side of the trade. What I am worried about is if the market drops suddenly and causes my trade, which is a bullish directional trade, to fail. That's what we're controlling. We're going to give ourselves the opportunity to make money if SPY continues up the way it has been, and we're going to use it to protect ourselves if the SPY starts dropping down like it could. There we go. That's the balance. David, where do you get the IV range indicator? Well, you become a member of Top Gun, and I give it to you for free. That's actually something that I worked on and coded. It's a Thinkorswim Think script, and it comes pretty much, you can click it and download it from any of my ALTV recaps. So, quick little survey around the room. I like people making decisions, so let's hear about this. Do we like the trade? Do we like the opportunity that we've got here? Because that's what it comes down to. Here's the core question. Are we being paid well enough to take the risk that we're putting ourselves into in this trade? Personally, I think it is a good, solid trade. It's controllable risk. It's got a graceful failure. It's got an excellent profit. And I think the probability of this thing being successful is very, very good. Can it fail? Heck yeah. Every single trade we take has a risk. We'll put some controls on that, understand how we're going to manage it. Is the chance of us walking away with a good, solid profit on this significantly higher than that possibility of failure? Yes, that's what I believe. Dawn, you can absolutely shift these around. And I tell this to every one of my people all the time. What I'm doing here is I'm walking through the concept and the idea, you know, as I see it in front of me. There's lots of variations on this. You can shift it down to 245. You could go down even further. If you want to get even more aggressive on this, you can go higher. I don't think going more aggressive is going to necessarily get you in a better spot on this one. But there are a lot of things that you can shift around. I want to teach you how to make your decisions on these trades. I don't want to, you know, I will walk through and I'll do the trade as I see it, but I want you to be smart, think on your feet, understand what's going on here, and make good, solid decisions for yourself. So absolutely feel free to do any modifications. Now, the trade. Let's take a look at this thing. A couple of things to deal with. Right now, we are looking, if I put this out at about a 90-cent debit, that is our max loss in this trade. I need to figure out how I'm going to size the trade, how I'm going to deal with the risk, and also what I'm going to deal with for a profit target on this one. By the way, a quick little hint, higher numbers on these debits, and I know this sounds weird, but higher numbers when you're comparing between different trade structures is actually a better thing. You're making a percentage return off of this, and the higher the number this is, the less your commissions and things affected. So having 89, 90 cents on this is not bad at all. I'd actually rather have that than a 15-cent trade. Now, as a general rule of thumb, I don't want to be losing more than about 40% of this. I don't think I'm going to get there, but I want to base my risk on about a 40% loss. A couple of things. I can put in stop limit orders to control the trade on this one. If it dips against me, I can manage the trade and pay attention to what's going on. I can make sure that the SPY isn't being knocked around by a bunch of just outside factors. All of those things I can exit well before I hit a 40% loss. I believe that just from experience with this trade and kind of knowing how it works, this is a controllable trade. This isn't going to be one that fails catastrophically. If we were to have a major crash down, I'm talking like 2-3% over 1 or 2 days, the implied volatility would jump so high on this trade that we would very, very likely walk away with either maybe a little bit of a loss, possibly flat, but it's really going to buffer us in this one. So I'm very confident that I can control this trade to a 40% loss. So what that means for me is this. Each one of these, let's assume that we're getting in at 90 cents. If I took a 40% loss in that, I would be losing 36 cents. Times 100, that means $36. Now, we run the ALTD portfolio based off a $100,000 account. And the way I approach sizing the trades is I want to size them based on what I believe my risk level is. Little side point here. It does not mean that every single time I'm going to be absolutely perfect about keeping this to a 40% risk. It means that 98% of the time, the majority of the time, I'm going to control it, and the losses based on this are going to be small enough that I can pick myself up and dust myself off and trade again tomorrow. So, you know, there is nothing perfect. If you plan on being perfect, you're probably going to be a fool because there's just no way to do it. But this is a really good way to size it generally. If I lost 40% on this, I would lose $36 per position I put on. For a $100,000 account, I'm allocating 2.5% of that account to the risk of this trade. So $100,000 times 0.025, which is 2.5%, $2,500. If I'm going to lose 36 bucks on every one of these, if I hit that 40% loss, I would take 69 of these. Well, I can't take 69.44. I really hate weird numbers, so I'm going to call this 70 contracts. There is the appropriate size for this account. Now, you can use the same formula for whatever account you have. In fact, you can tweak it a little bit. Just size it to whatever you believe risk capital is, and think through and make decisions. Now, I'm going to strongly say this. What we're doing here is education. You should be following along on a paper trading account. And if you're going to do anything outside that, please be careful, make your own decisions, and get some advice from a broker. Legally, I'm not allowed to give you any advice on live trades. But here we go. There's the trade. Okay, just about to fire this off. Is anybody here seeing any kind of critical reason why we should not do this? Anything that is ready to completely blow up in our face? Okay. By the way, I've had some people say that they've had trouble getting out of these things on Options House, especially with SPY. This one should not be a difficult trade to exit at all. And this is literally just a standard calendar trade. There is nothing fancy about this trade. We're just paying attention to the volatilities to make it work. If anybody has any difficulties on their trading platform dealing with these things, number one thing I would tell you to do, please call your trade desk. They're the ones who are professionals, know their platform exactly, know how to do all of this stuff, and they can walk you through. There is no reason why there should be a hassle on this trade. This is just about as plain vanilla a trade as you can get. So if there is, get your trade desk to help you on that, because they're the ones who can tell you exactly how to make it work. If they can't make this trade work, then that's weird. Sorry. Okay. All right. I placed it. I got to fill very, very quickly. SPY's tight spreads, easy in and out. We should have no troubles. I got filled for 88 cents. So let me just do this real quick. I got to send off the alerts. And by the way, I'm going to set up the controlling trades on this thing too. So and we got to fill it 88 cents. Okay. Okay. There. There. Now, what you're getting right now is just the alert. This is just the absolute basics of the trade so I can get it in your hands fast. As I said, after the session is done, I do a full write-up which explains everything about the trade, all the details about the risk management, how and why we're doing this, literally everything. So have a little patience on that and you will get a full write-up on the trade. Come on. Okay, there we go. Okay. All right, getting back to trades, let's take a look at a couple of things on this one. First of all, we are going to have a couple of plans to basically limit risk on this trade. First thing, I'm going to just put in a keep me from being stupid type of a control. And this is what I would call an eject point. Flat out, do not use stop loss orders in the options market. I'm just going to It's one of the few absolutes I will ever say, is do not use stop loss orders in the options market. SPYs might be one of the very, very few symbols that you could possibly get away with that on. But a stop loss order is going to issue a market order on each leg of your trade, which is going to give you the absolute worst slippage you can possibly get. And that can be really serious in the options market at times. And you are going to lose a bunch more money than you should lose. So how would I deal with this trade? First of all, let's figure out what the price is that we're going to be dealing with. 88 cents is our fill price. I want to limit this to a 40% loss using a stop type order or an eject point. So 88 cents times 0.6, which is just the inverse of the 40% loss, means that the price on this would be 52 cents at the time of exiting if I got out of this trade at a 40% loss, or 52.8. I'm just going to move this up a little bit, call it 53. So what I want to do is create an order on this. Now, in this case, I'm going to use a stop limit order where and I'm actually going to go in on a little bit of a complicated order here. Stop price that I'm going to use is actually going to be about 55 cents. And the limit price that I'm going to use is going to be 53 cents. So what did I just do here? Basically, I'm creating an order that when the value of this trade hits 55 cents, it puts out a limit order of 53 cents, which should exit this trade a little bit quicker. This is putting a bit of an advantage in. You don't need much in SPY. And let's see. All right, these numbers are wrong down here. When the market price is at or below 55, the stop is triggered and a limit order will be submitted to execute actually at 53 cents. So that is going to be one of our controls in this. Now, I am hoping that that actually never gets used. I don't want it to be used. But it's there just so that if I'm off golfing and something crazy happens in the market, it's controlled and I've limited my risks. Is it perfect? No. There are issues with that type of an order. If you have a really, really crazy fast market, let's say we have an enormous crash in the market, and it happens all of a sudden, that order could get moved right by. If you're worried about that, you can basically drop the price that you're executing the limit order at and make it more aggressive. But I'll tell you what, that happens extremely rarely. I'll take the risk because the stop loss order will chew you up in this market. And you know what? I just realized something. I need to set this to good to cancel. So hold on. Sorry about that. Did I put it out already? Okay, I didn't put it out already. Didn't put it out yet. So it needs to be good to cancel, confirm send, and good to go. So there's one part of our controls. At 55 cents, we're going to put in an order to exit 53 cents, and that will control us even if we're not paying attention. Number two, we need to make a decent idea of what our profit is going to be on this trade. We need to have a couple plans on getting out of this. Now, my preference is that let's be a little bit lazy. Let's create a target that is reasonable, that we should be able to hit, and let's make some decent money on the trade. There's a lot of things we can do. We can sit here and manage it by hand. If you're an active trader, that's a wonderful thing. I'm really a big fan of that if you're willing to sit in front of the computer all day. Otherwise, a simple way of doing this is not necessarily have to watch it every minute, but have a stop loss, or excuse me, a limit order to exit the trade at a specific price. So in this case, I'm going to just do a standard limit order, And I would like to make a 25% return on this trade. So if I enter this at 88 cents times 1.25 is $1.10. Now I'm going to pad this just a little bit just to cover a couple of cents of my commissions, and I'm going to put a profit target on this thing of $1.12. Just a little bit in there to cover some of that stuff. So set it as a good to cancel. If I hit $1.12, whether I'm sitting in front of the computer or not, I have just made roughly a 25% return on my trade over X number of days. Now, depending on the situation, there's a lot of different things that can go on with this. I want to manage this and I want to be aware of what's going on in these trades. And I want to be paying attention to this. And I may choose to make different choices. I can cancel this out, make it a little bit more aggressive, especially if we see some implied volatility coming in. If this, if SPY continues to move up solidly, then I may make some different choices. But for right now, I want an easy way of getting out. $1.12, 25%, I'll take it. So good to cancel, good. There. Now, there is one last scenario that we have to pay attention to. Let me take this out. Now, the peak of our profits is at 145.50. This is going to depend on what you use for strikes and your choices. But if I go past 245.50, then I'm now on the backside of my profit range. In fact, I'm dropping. So, and that doesn't matter what day I'm on, I've reached the peak. Now, early in the trade, there's actually an advantage to leaving it in longer. There's a theta erosion advantage that is quite powerful. So we don't want to necessarily trigger exactly at 245.50, but what I do want to do is this. I'm going to create one last closing order trade. And this is going to be another form of a stop limit, but this one's going to be a little different. It is going to use, let's see here, when the SPY mark price is at or above 245. I'm not going to use 245.50. I'm going to give it an extra 25 cents. 245.75. And my rule is going to be a limit order linked to the mark price, and I'm going to subtract 2 cents from it. So, okay, let me explain what I just did here. When SPY hits 245.70, this gets triggered. I'm going to put an order out at whatever the market price is for this trade minus 2 cents to sell it. So I'm going to put a little tiny bit of an advantage to get me out quick, and this trigger will happen. There's a very good chance that at this point I would be in a reasonable profit. What I don't want to have happen is to go buy that profit, and good to cancel. What I don't want to have happen is to have it go buy that profit and start to go down on the losing side, losing profits for me. So 3 basic things. I will do a full write-up on exactly how all 3 of those things work. You'll get that a little later on today. There's our game plan on the trade. Beyond that, we have to have this trade completely closed out by, let me see here, the July 7th. We do not hold this trade in any way past that. You could theoretically analyze a new trade that may use the long call option if you want. I encourage you to treat that as a separate trade, though. Okay, questions. So, stock price I used to trigger the closing order, Robin, that was 245.75. That was 25 cents past our strike of 245. Or excuse me, 245.50, sorry. The Mark, trying to figure out what trade I am talking about. I just entered a, here, actually, let's just do this. Mark, there. 70 contracts, short the SPY July 7th, 245.50 call, long the July 28th, 245.50 call, costing us 88 cents debit. We've got our profit target set at 112. We have a stop loss set at, or a stop limit order set at, I'd have to double check the exact number, but right around 58 cents. We are going to close this trade using a limit order in the market, giving an advantage of 2 cents if SPY goes past 245.75. So there's the rundown. Any other questions? Dan, yes, you should be using OCOs. One cancels others. Been having a little bit of trouble in that, and to be honest with you, we've got 2 more trades I got to nail down. So one cancel other orders means that if any one of these orders executes, the other order is actually automatically canceled, so it doesn't expose you to the risk of double executions. Really strongly encourage you to do that. One of the problems I have, though, is that every single platform does it differently. Really take a look at the instructions for your trading platform or your brokerage, and those are a very, very good thing to do. And so, yes, good recommendation, but instead of going through technical details of how to set up a particular style order for one platform, I'm going to move on to a new trade if you don't mind. So Kent, will the broker allow, excuse me, will the broker allow 2 profit stops? If you have enough margin in the account, yes, but no, they may not. Wow.
Hey folks, as Doug's nearly dying here, and I really hope he doesn't die because that would be bad. He's going to wrap up questions on this trade, guys, because he's trying to be nice and give you 2 trades. So he's going to ignore some of these questions, or I'm going to get the hook like he said last night, because Doug's a great dude and he'll stay in here forever. So let him press forward and get you the second trade, or he's going to run out of time. So you all right, Doug?
I'm good. nothing like joking to death on air. Yeah, that would be a viral one. Okay, sorry about that, everybody. So all good on that trade. As I said, I'm going to be firing off an alert later on. It's going to have a ton of details about this trade. You're going to get all kinds of important information on how we're going to manage it, how we're going to use it. So there is SPY. We've already got filled on NVIDIA this morning from the things that we did last night. Now, time-wise, we're getting a bit limited here. So I am going to give you an option. I'm going to describe 2 trades. You are going to tell me the one that you want, you've got the most interest with. And I want to get some feedback here. I want to see votes up on the screen of, just give me the symbol of the one that you'd like the most. Here are our 2 options that I am looking at right now. One is what I consider a very interesting trade on UNH. Let me explain why. UNH, United Healthcare Group, obviously has a very, very solid trend. That's an excellent thing to work with right there. It's got a very nice high price, 181.38, makes options trading easy. But what is really cool about it is that in about a month, we have an earnings announcement. Now, earnings announcements are a point in time when a huge amount of information come out on the stock, and it changes the volatility on some of the options. So the trade I've been looking at in this is actually not terribly different from the trade we're looking at on the SPY, but I was using earnings announcement and the change in implied volatility to create a trade that potentially has a much better outcome. So that's scenario number 1. Scenario number 2 is WYNN. 132 bucks. WYNN has been on a interesting little bullish run here. Now, a couple of things about WYNN that's very interesting. Number 1, we've got a good bullish run on WYNN. We've got moderate to low implied volatility, which means that I probably wouldn't do this as a straight bull put spread, but I can create a trade called a back ratio that it's a really interesting trade. It allows us to have some very, very good profits in the trade if the stock does what we want, but it also allows us to do a very, very tight control of the trade in terms of risk if the stock fails. And it's a very, very interesting trade in this market, because if WYNN or the whole market were to go nuts and drop and have a major correction, it creates a very profitable, interesting trade. Now, I haven't gone over back ratios too much with too many people, so it's an interesting trade for people to look at. So here we are. We are voting right now. WYNN or UNH, which is the two? You're getting one. Yeah, Glenn, it's not worth the fame, okay? I'm not looking forward to being the viral winner here. Wow, we are getting a serious, okay, WYNN is coming out. No, you're right, Glenn. I just don't want to be the winner of that viral award of the year. WYNN. Okay, here we go, WYNN. So, different style of trade. By the way, earnings season's coming up in just outside of 30 days. We are going to have a ton of new earnings trades coming up, lots of different opportunities. So lots of things coming up there. This is probably a good one to work on now, because we may not get this opportunity as much. Step one, we have identified a stock that we believe is bullish or bearish, doesn't matter, I can go in either direction. I believe the trend is consistent. I believe the trend has reason and it's going to continue. I'm looking for something that I wouldn't necessarily get a huge amount of premium on, because the volatility is not necessarily outrageously high. It doesn't have to be at the absolute bottom, like it, you know, calendar spreads, like a directional calendar spread, you really want to have volatility down near the bottom of its own range before you put that on. In this case, though, I don't need that. As long as I'm close to the bottom, I am doing pretty good. If I were to do a standard bull put spread, I'd probably be using about a 20 delta, picking a time frame for it, and trying to make the thing work. It would most likely end up being a trade that's marginally good, not necessarily outstanding, and if the market were to turn around and drop, it would have a lot of risk in it. So in this particular case, you know, and by the way, part of that's driven by the fact that the volatility is low. I'm just going to get strikes too close to the current price of the stock. The risk of things going back against me doesn't make that a good trade. So let's try to do something different. Let me clear out this junk on the screen. I don't like too many lines. I'm going to take and create, first of all, an outrageously aggressive bull put spread. And I say outrageously aggressive because it is specifically almost balanced around the current price of the stock. And it's a little bit wide. I am selling a put at 135, and yes, that's in the money, and we'll talk about that in a second. Because there are some specific risks on this trade that you may or may not want to deal with. And I'm buying a 128. So what I've done is pretty much split the difference here. Put the short an equal distance above my long, and I have generated a nice, big, huge chunk of credit on this trade. Now, the overall spread on this is $7. The credit I'm receiving is $3.20. Now, would I take that trade all by itself? Heck no. This is, you know, unless you were an absolute prophet, an oracle, and you knew exactly what was going to happen on WYNN, this trade right here is an extremely aggressive trade that could win great, wonderful, or it could blow up in your face and fail very fast. That's not what I want to deal with. So I did this on purpose, though, because this generated a huge amount of credit. I can take that credit and apply some of it to getting rid of risks. Now, this is a very, very standard thing that you have in the options market. If I were to draw a picture in your mind of what the options market really is, it's a whole series of trade-offs. It's a series of knobs. You twist one in one direction and it moves another in another direction. So what I've got right here is a huge amount of top-end profit that I am taking with a huge amount of risk. Well, I can use some of that profit to pay off and make some of my risk go away. To do that, I'm actually doing something fairly simple. I'm just adding in an extra number of contracts on my long put. So my 128 put, I had 10 short on the 135 strike, 10 long on the 128. I'm going to add in 10 more long on the 128 strike put. Now, I'm giving up some of the max profit in this trade on purpose, but what happens is I generate this control. Now, this is looking at the P&L of the trade at the expiration. And I want to make a point here. This is not a trade I intend to hold to expiration. In fact, I might tweak the dates that I'm using on this because my goal is to actually only use this trade for a portion of the life of this. You know, this 128 long put that we added on here gives us protection, but only if things really, really crash substantially back here, which to me, it's not that big a deal. I mean, I don't think that that's going to happen. It's great. If it does, I have amazing profits. But do I think that's likely? Not likely enough that it makes putting in this extra expensive long put worth it. But what does make it worth it is this. It's not what the P&L looks like at the end of the trade. It's what the P&L looks like in the middle of the trade. Let me just double check. No volatility adjustments. Good. So here we are. Now start paying attention to the red line. And that is not entirely right. Hold on. There we go. That looks a lot more like it. Got to play around with this a little bit. We might have to shift the strikes a bit. Hold on. Because we're going to want to tweak our max profit versus our risks. So hold on here. I'm just trying to get this balanced off, to be honest. There we go. That puts us right about in the area that I'm looking for. Okay, let me explain what I'm trying to do here. I'm trying to create enough credit on the trade that after we put in the long puts, we have a good solid credit and an amount of money or amount of profit that we can basically work with. Now, profit-wise, it's not a steep slope, but remember, the goal of this trade is not necessarily to knock a huge home run, it's to have a very, very controlled risk trade that has a good potential of making us a reasonable profit. The more control, the lower risk. The more controlled the risk, guess what? One of the trade-offs is you're going to make less top-line profit, but it can be a very good trade still. Now, this is the piece that I want to point out to you. I actually had one of my members from my Wingman Group coaching group call this the Valley of Death. I love the name, so I'm stealing it. So, so Kevin, thank you for that. Now, this is looking at the P&L. The purple line is looking at the P&L today. If the stock goes up, if WYNN continues on the path that it's looking at, we're going to be slowly making a profit. Every day that passes, that will actually start to slowly move up and get higher and higher and higher until we're finally reaching a max of about $210,000 on this size. We will resize this too. But the flip side of that is this. If WYNN suddenly drops. Now, quick question. Who was sitting here expecting, who knew ahead of time clearly that all of those tech stocks last Friday were going to do a whipsaw down? Anybody know that? Did anyone actually expect that and have it as part of their trade plan? I mean, maybe you had it as a far out, but did you expect that to happen? We don't know when bad things are going to happen, but I do know some of the things that do happen when bad stuff happens. I had this style of a trade on Applied Materials last Friday when that happened, and that trade went, Applied Materials went way down, blew through the bottom, and bam, hit a profit target and actually walked away with a win on a trade that was designed to be bullish. That's the power of this style of trade. Now, I want to show you what happens to the trade when the stock drops. First of all, the implied volatility is pretty low on WYNN right now. If I were to just take a quick little estimate, if WYNN were to drop, it really wouldn't be surprising to see implied volatility head up to about 40, 42%, potentially even higher. I mean, WYNN's implied volatility has been excessively high in the past. I'm not saying it's going to get back up that much, but seeing a nice little bump on implied volatility would not be surprising at all. I mean, look how high this thing's been in the past. And just recently, during this upward trend, it has dropped down and settled in at this low level. If this trend looks like it's going to fail, this implied volatility is going to head right back up here. So I'm going to use, I don't know, 38, 39, maybe 40 as my target. Let's take a look at this. Let's assume that a couple of days have passed. I'm looking at the 24th, 10 days, or 25th, 10 days from now. We are currently sitting at an implied volatility of about 29. I think that this thing's going to head towards 40. I'm going to be conservative. I'm going to add 9%. It's not even getting us all the way to 40. That's actually more like 38. Now, God, I wish that was a little more dramatic when I pressed the button, but what we did was we created this entire zone. If we were to have WYNN come crashing down, I don't even care how low it goes. We have an extremely limited risk here. Like literally, maximum losing in this area is $400 on what could be a $2,000 profit. If it goes way down, I am starting to move into a fairly substantial profit zone. So if the market comes crashing down, I have very little risk. Volatility is buffering me and stopping me from losing money. I have plenty of opportunity to make money as WYNN goes up the way I expect it to. And if it goes way, way down, I also make a profit. So where does this trade come in your portfolio? When you're managing portfolios or trades, one of the things you have to be paying attention to is how balanced you are and how are you controlling your risks overall. I can have bullish trades. If I have a whole portfolio of bull put spreads, you know what that means? I am extremely bullish in the market. My portfolio is long delta. I am also short volatility, and if the market does something crazy, corrects, moves against us, I am suddenly going to lose a lot of money across the board. I'm going to be scrambling on every single one of my trades. So, smart trader looks for good ways to balance that off. They try to find a handful of bear call spreads. Now, that takes care of some of your delta problem. If you find good, solid trades that are bearish, you mix those in with your bullish long trades. Now, market comes crashing down, half of your trades are losing, but the other half are doing okay and helping you balance that all off. But you still get a volatility problem because bear call spreads and bull put spreads are both short volatility. So then you try to add in some calendar spreads, which are very long volatility, actually like the SPY trade. That helps you on the volatility piece. Now this helps you on the extremes. Adding in a few of these allows you to create opportunities that when the rest of your portfolio is failing, because suddenly the market went in the opposite direction from what you ever believed was going to happen, it's suddenly making a bunch of good money. Is this going to be the most exciting winner? Are you going to take and run down to the pub and say, hey, I made a huge profit on this? No, but it actually can be an excellent winner. It can be a very good profit. Very good returns, 15%, 20%, depending on the trade that we're doing. Key, though, is it's got exceptionally strong control. But this control goes away, and this is why we've got to pay attention to how we create the trade and how we use the trade. So time-wise, here we are. We've got July 7th as the expiration on this. I may actually want to change this. As we get closer and closer to July 7th, we now see the valley of death. If we're up here and WYNN is solidly up in the 137, 138, 139 range, which it could be over the life of this trade from it trending up, we leave the trade on. We leave it to do what it's supposed to do because right now we've got time erosion in our favor. We're making money. And this is pushing us more and more towards that max profit that we wanted to get. On the other hand, if we're down here, let's say we're down in the 131, 132 range, well, every day that passes, we are going to be losing money. And the valley of death that we have here is getting deeper and deeper. And if WYNN were to move down at that point in time in the trade, we expose ourselves to more risk. We don't want to do that. So we put some time limits on this thing. We're not going to hold this trade to the very end. If I have not gotten up past my target, probably put a limit on this of 134. If I've not exceeded 134 by day X, which in this case oops, for me would probably be June 30th. Now, on June 30th, at this size of a trade, the worst I can do is a $1,400 loss. Based on the overall size of the portfolio and my risk parameters, that's an extremely acceptable loss, and I would manage the trades so that it didn't hit that anyhow. But if I made a rule that if I am not above 134 by the 30th of the month that I close the trade, I basically make it so that I am never exposed to this max risk up here. Very, very low risk trade, very, very controlled trade, as long as you trade it with some discipline and understanding of how the thing's going to work. If things go bad, I've got a lot of control. The failure on this trade is going to be extremely slow. It's going to be very controlled. I'm going to be able to limit my risks and limit my downside, which means that a smaller return on investment on the trade is a perfectly acceptable thing. This is the type of trade that you can go 2 or 3 days on vacation, as long as you have a couple of controlling orders, some limit orders and things like that. You don't have to care, because over the time frame you're going to be doing this, it's either going to work or it's not going to have a lot of downside risk. So there are our trade-offs. There's our decisions that we need to make. Do we like the trade the way it is? Do we want to be more aggressive? But remember, more aggressive, more potential profits means more risk. Means that you've got to be more attentive. You've got to be handling the trade better. Or do we want to be more passive? This is a very good possible profit. We're looking at about a $2,000 profit here for a trade that's, hold on here. This will be about a $7,000 trade with $2,000 profit, just running really, really rough numbers. It's a 28% return. Considering over the life of the trade, as long as we follow our rules, we don't expose ourselves to any major loss that's even close to our max risk limit. Getting even 20 to 25% over 3 weeks to play this trade out with very, very tight control seems like a really good trade-off to me. It seems like a really solid, good possible trade. So what do you think? And let's get some feedback here. Let me see. You had this dream but decided not to trade on it, okay? Well, Glenn, you're going to have to tell me what your dreams are more. Well, okay. Limited to the trading dreams, okay? Right now, a lot of what we're doing is trying to set ourselves up for the profit, create the opportunity, create the setup to make money, but at the same time, controlling the risk when things fail and blow up. You know, I'm not sure if I've had this much uncertainty and anxiety in the markets for years. I've been trading too long now, way too long. I'm actually officially moving into the grumpy old trader stage of my life. You get there after a while. I've had 20 some odd years in this whole game. I don't want to deal with the BS of horribly uncontrollable trades blowing up in my face. And right now, it just has a feel, the market has one of those feels of very high anxiety. You know, low VIX means that there's not a lot of people hedging. We've got excessive, PMEs. We've got all kinds of potential for drops. So I want to control my downsides. This works well for me. Tech stocks flash crash. Yeah, Glenn, by the way, this trade right here on Applied Materials did outstanding on that flash crash. That trade made a profit during that flash, what was called a flash whipsaw. It wasn't really a crash. It was a whipsaw. During that moment, I had it set up to take a profit at a certain point in that Applied Materials trade while I'm sitting there sweating bullets on half a dozen other trades that I've got, in several of my other portfolios. It actually worked out pretty well that day. It did pretty decent overall. That trade right there went down and ding, hit a profit down on the lower side and made me a bunch of money. So there you go. There's a bonus. So let's size this thing out and take a look at what we're going to be doing on this overall. So we've got $2 on this for 9 times 10. Hold on here. To size this, I would put a 40% risk factor in there, which is effectively a 40% stop loss, which means we'd be losing $2.80. But here's the practical thing about this. I'm using that calculation as a 40% loss off of our max loss. But as long as we follow our rules, we are never going to get close to that. So I'm actually going to leave this at 10 contracts. I'm going to take this this put and actually take it out, and I'm just going to change this vertical into a back ratio. I did these separately so I could show you what this trade really is. It really is an aggressive bull put with a set of long puts that you're basically getting rid of a bunch of risk with. But when you place the trade, I'm just going to put it as one trade. There we go. So I've got 10 short, 136 strike puts, July 7th expiration. I've got 20 long, 127 strike puts, July 7th expiration. Fairly straightforward, not a lot of pieces, not even a lot of contracts. We don't have to chew up stupid amounts of commission. Overall, we walk away with $2.13 credit. I am looking pretty good overall on this thing. So, anybody? Glenn, is there a way to even flatten that low side of the dip before it gains in the downside, not without really reducing your profit? Glenn, this is what you end up getting in this, is the trade-off between the risk you're exposed to over here to the potential profit you can get over here. If I want to drop my profit more, I can actually level it out and reduce the risk even more. But then you become challenged because you're not using your margin particularly effectively. You're not making enough money off of the money you're putting into the trade. And it does get to a point where you start to get minimal return on the effort you're putting into the trade. So don't go too far that way. There's still a little bit of kind of, I don't know, tweaking it, playing with it, trying to find a sweet spot on the trade. But I think, as you play with these and work with them, you start to see kind of a pattern. I found, in general, a relatively wide set of strikes, in this case about actually $9, centered on the current price of the stock, so half above, half below. Now, I'm going to put out one thing that is a specific risk on this trade that you have to pay attention to, and this may affect your choice as to whether to get into this trade or not. We have a short put that is in the money. It's not outrageously in the money, but it is in the money, which means that there is a chance that we will get an assignment on this trade. Two ways of managing that. One, if you want, you can execute the other side of the trade. Take 10 of your puts and tell your broker to execute those, and the shorts and the longs will then neutralize in terms of the stock you get, and you will have no position. Or two, basically sell the stock in your portfolio. Most brokerages have a policy that you can set up with them that they will just instantly liquidate those stocks. But you do need to talk to your broker and figure out what that is. The one thing you do not want to do is ignore that phone call that you just got an assignment and let it go overnight, because then you could potentially have a margin call in your account. That is the one piece. I don't think the risk on that is excessively high, but it is there. Just be ready to deal with it. An assignment is not an outrageously horrible thing. It just creates a big chunk of stock you have to deal with. It's a pain in the butt. Technically, an assignment means that somebody gave up a nice little chunk of profit to you early, and you could walk away with that profit. You're being paid to take that stock early. Do I think that it is a major risk that I absolutely would not take in this? No. In this particular case, I would be willing to work with that risk. But I do want you to be understand that it does exist and how to deal with it. If you get that, the broker will probably call you or send you an alert or something and liquidate the position right away. Don't mess with it. All right. Jim, how about $10 wide and 21 July for list slippage? Willing to look at it real quick, but I do want to wrap this up.
Yeah, folks, we're going to try and knock it off at 11. So Doug's going to go on point to point. He's going to go direct trade, and he's going to ignore you guys. Remember, this is one of the reasons where we only limit. We have like quadruple the number of people that are in here normally. And Doug, as the good instructor, is going to try and answer everybody's question. He's not going to do it anymore. So, if, Doug, you knock out your trade. If we have some time at the end, you can circle back around and answer some questions.
Yeah, actually, I think I'm going to go with this. By the way, your suggestion of exploring July 21st and maybe doing a $10 spread, I think is a great suggestion. I think it's a good idea. Always recommend poking around at the trade and trying to find different ways that you can make it a little better, make it work for yourself even more. In this case, there's the challenge of premature optimization of a trade. There's a point where you're just trying to tweak it and tweak it and tweak it, and you're trying to make something so perfect that you're never going to get there. I'm sticking with this for right now, but I sincerely think that it'd be a great idea for you to put some effort into poking around and exploring the trade and see if you can make it even better. If you do, post it in the ready room. Post your modification of the trade in the ready room. We'll do a little compare and contrast and see how these turn out. Always love to do that. It's a great learning experience, and it's a good opportunity for us to all get something out of this that above and beyond just what we talk about here. But I'm going to stick with this one right now. So confirm and send, ALTB, good, 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 happy, happy, and so I'm sitting here right now waiting for my 10 short July 7th 136 put, 20 long July 7th 127 put to get filled for a 217 credit. I put that in at the midpoint. It's a little bit of an advantage on the market right now. I might shift this down. I could potentially drop this by 2, 3, maybe 4 cents. I don't want to chase this too much. The further I chase it down to get a fill, the less of a profit overall I'm going to get. And that really, it's a good way to get in the habit of doing that. It's a good way to make your profits go straight out the window. You want my real advice on chasing? Don't do it. Put the effort instead into creating 3 or 4 other good quality trades that all make sense, all fit into your portfolio. Put them out into the market and get filled on the ones where the market gives you the price that's right. And when you get the fill for the day that you want, it's like fishing. You got your catch, your bucket's full, good, you're done. Close out the other trades, walk away. But make the market work for you as opposed to, I got a bunch of buddies up in Chicago which will be very, very happy if you chase these prices because that's going to help them pay for their cars, pay for their houses, and pay for their vacations. My recommendation, if you're going to put work into anything, put work into alternative orders. And we just got filled at 218. So there we go. So a couple of things. By the way, I'm going to do a full write-up on this. And I'll put in all the rules of the trade. But let me send this out really fast. Actually, I'll tell you what. I'm going to run through the rules of the trade real quick, and then I'm going to hand it back off to Wiz, and then I'm going to send the alert out. I really shouldn't do it that way, but time-wise, I just don't want to sit here, have you watching me do a bunch of things. We just got filled on this trade at, let's see here. We just got filled in this trade at $2.18 credit. We have a $9 spread on this thing. So $9 minus 218 is $6.82. That right there, in theory, is the max loss if we don't pay attention to the rules I just laid out before. That's the max loss if you're dumb. Please do not be dumb. Follow the rules, understand how the trade works, and don't let it trap you. But one of the things I'm going to do is make sure that I'm not going to be dumb and put in some kind of control. 682 times 0.4, that's a 40% loss, is $2.73 per position. Okay, if I just received $2.18 credit for this, that means that if I have to buy this thing back at, let's see, 218 plus that number If I have to buy this back at $4.90, I have basically just locked myself into a 40% loss. If I follow all my other rules, I should never get close to this. But market's a weird place. It can be irrational. It can be strange. So I'm going to put in some controls on this just to make sure that nothing dumb happens. So quick little order. Hold on here. And we are on WYNN. Closing order. I'm going to put my stop limit. Remember, the price that I'm shooting for on this is $4.90. That's a debit. So if, in this case, let's see, the limit, stop, okay. If the debit goes above, I'm just going to say 485 in this case, I'm going to put an order out to close this at 490. This is a stop limit. When it hits this, it issues this. Going to put that as a good to cancel. Going to just double check the order. Yes. 45 debit. 490. Good. So that's exactly what I want. That is just to make sure I don't make a mistake in the trade and do something silly. So good to cancel. That will stay on. And yes, you should do these as one cancels others. Please take a look at your brokerage platform to see how to do this. Confirm and send. Good. Number two, how am I going to make a profit on this thing? I'm going to have a couple of kind of general rules in here. If I were to make, I would say about 80% of this. Now, this is a little bit magic numbers, so I don't like to do this too much. But if I were to make about 80% of this between now and June 30th, I would be happy to walk away with that trade. Take it off the table, take the risk away. So if I did that, let's see, 218 times 0.8, I would be making $1.74 times 100 times 10. I would be making $1,744 in this trade, which in this particular trade is a, what did I say on this? Hold on. 682. 25% return. All right, so if we get 25% return in the next 2 to 3 weeks, are we happy with that? I am putting in a profit target at that point. So that means that if I were to close this trade out for a debit of, let's see, 218, if I closed it out for a debit of 44 cents, I would walk away with a 25% return. So let's just do it. Create closing order. Of 44 cents. Sometimes these get really confusing the way that Thinkorswim does this. Could cancel. That means I'm going to buy it back for 44 cents and I've already received $2.18 in credit. So confirm and send. There is a profit target for us. Now, the last one I'm going to do is just a wake-up call. This is not an actual trade. I'm going to go and stick on an alert that says if the what I want is basically a little, okay, I'm not going to do this. You're going to have to put a little thing in your calendar that says on June 30th, part of our trade plan is to evaluate this trade. If the stock is up around 134-ish, we are going to hold on to it and let WYNN continue up and continue to make profits. If we're below that, wherever we are, we're going to evaluate it, see what the risk is, and very likely close the trade out on June 30th or around that date to prevent that value of death from forming and to minimize our risk. So there we go. We have our trade plan. Now, I'm going to go send out the alerts on this. Anybody have any final questions? Would a bull calendar be at least as effective? El Grillo, a bull call calendar would be would create a greater profit margin, but it would also create greater downside risk. which if you're willing to accept could be a good trade-off. There's nothing wrong with that as a trade, but the big thing about this trade is the very tight control of risk. If you put a bull call calendar on this, your downside risk is going to be substantially higher. That may be a reasonable trade-off. If you believe that the movement up is consistent and solid, you can make more money, but it's all about control. So in this case, I'm going to use the back ratio spread. All right, I'm going to wrap it up, and let me see here. Yeah, Robin, I am doing 2 for 1, which is the back ratio, and I am putting in a closing order based on a profit target. Now, it doesn't mean I can't manage this in other ways. If I see greater opportunity as I manage the trade, I might change my plan. But I want to do it based on evidence I have in front of me at the time. Right now, my evidence is if I make 25% in the next 2.5 weeks, I'm going to be jumping for joy. So there we go. I'm also doing that while I'm risking only a portion of the overall trade. There we are. I might have done a little bit of a bad calculation on that, Robin. So I'd have to double check that. I might be, you caught me by a few cents there. Sorry. Sometimes I do these quick. So yes, it might be 80%. Oh, by the way, Robin, I know what the problem is. You're calculating that as the percentage of your max profit. I'm calculating that as the return on investment. So that is all based on the cost of the trade itself. I think that's where the difference is, Robin. They're pretty close, which makes it confusing. But I'm looking at the return on the investment that we put in, which is about $6,800, and the dollars that we would get back if we closed it out at that 80% of the max credit. So that's where we would be differing on that one. Where do you learn all those basics? Full Throttle. That's where you learn them. We are going to be talking about all kinds of this stuff. This is what we do in Full Throttle. That's why we're here for these things. Yeah, it's good. And by the way, for all the people that are my regular members who've been here for a long time, I really want to remind you, in a short period of time, we're going to be running the next Full Throttle session. Come back for the refresher. Pick out the classes that you want to get the, that extra deep dive into, and come on back. It's part of your service. It's free. It's there. Take advantage of it. So I want to see some old faces there. I always do, but just want to remind you. There we go. Anything else? All right, Wiz, I'm going to hand it back to you. I'm 2 minutes past 11. I think I did pretty good for me on this one.
You did, man.
By the way,
that's a pretty tight time on target for you. So very well done, folks. Everybody give Golf a nice golf, or Doug a nice golf clap here for his advanced live trade brief. Like I said, folks, we open the doors and you get to see, he obviously would have covered more positions and existing positions, just like I would have done in my live trade briefs, folks. So you got to eavesdrop in on a no kidding live session with Doug. Real quick, folks, take a look at this. This is the Ready Room. A couple of you guys were asking about that. You interact with Doug and I live, obviously, 4 or 5 times a week. And then in between, if you wake up in the middle of the night in the cold sweat, you want to post something, you can get in our Ready Room, it's called. The Ready Room of a fighter squadron was where you hung out. You interacted with your senior pilots, junior pilots, your squadron mates. I learned more about flying and fighting the Hornet in the Ready Room than I actually did, from a book. So this is our interactive forum. It's very, very timely. Doug and I usually get an email that says somebody new posted. I mean, we don't get on it immediately, folks, because we're managing portfolios, but we'll get back here if you have any trading questions. Okay, so this is called the Ready Room, and you guys can jump in here at any time. I'm a hands-on learner. How much training one-on-one happens? Tanya, this is the training you're going to get with Full Throttle. There is something called WYNN group coaching. We'll probably do in maybe a month or so, where Doug takes, about 7 to 12 folks, no more than that. It gets a little too big. It's called WYNN group coaching, where you do get some one-on training with Doug, and then also it's like a little hedge fund. You guys get to learn, be portfolio managers, risk managers. So that's the one-on-one training. Doug and I do one-on-one coaching, but that's not part of Full Throttle. Our time is pretty valuable and limited. So But folks, as we went, I didn't keep track, no offense, but I know we're in the lower 20s as far as slots. So if you were one of the ones sitting here waiting for Doug to do his advanced live trade brief, and now you got a vertical head nod and a golf clap, you got to grab your slot because we're in the lower 20s. The customer support line was ringing like crazy. I'm not answering that. I was watching Doug. So if people are trying to order by phone, the slots are going pretty quick. So, yep, Kev, Wingman Group Coaching is worth it. Thanks for the kind words for Doug. Well, don't want to confuse anybody. That ain't this. This is called Full Throttle, folks. It's time for you to grab your slot. Defensive is everything we do here at Top Gun Options except weekly options, because it's defensive. If it's a little bit more defensive, you get the accelerated retirement brief. The offensive track, you get everything, obviously, and instead of retirement, you get the weekly options. Okay, and obviously, Burger King, you can have it your way. If you want to do weeklies, NAR, and everything we do, it's called Max Afterburner. And I think out of the 27 or so that have gone, I'd say anecdotally about 23 of them have been Max. A couple defensive, a couple offensive, and yes, the answer is if you want to upgrade a track down the road, hey, Wiz, a couple people last night and this morning took defensive, and absolutely, man. Once you get comfortable here at TGO and you want to start to learn how to trade weekly options, just give us a call, and you just pay the difference, obviously, and just do some mental math there. These are annual prices. Somebody asked earlier, that made me laugh. Like, are these monthly prices? I'm like, for you, sure. That's what you want to pay. But no, these are annual memberships, folks. We will have a special announcement tomorrow at the 1 o'clock brief if we don't fill our annuals, but I guarantee it, we usually do. Maybe there's a handful that, no kidding, wait until the end after seeing the weekly options brief to grab their slot. Real quick, though, here's an Obama teachable moment as far as volatility. I sent this out. I didn't want to be in Doug's ALTB there. But I tried to close out my VXX bullish double vertical on Tuesday when the tech wreck happened Friday and Monday. My VXX trade was up like $700. It was like a 25% gain. I sent out an alert to close it. Sucks. I didn't get filled. Well, look what happened today. Tuesday, Wednesday, the market rallied and this VXX trade imploded. What happened this morning? Another Thursday where, what was it, 4 Thursdays ago, we had the Comey memo. Here we are 4 Thursdays later. Now we got the Mueller memo, or the Mueller leak. And this trade went from being down about $2,800 yesterday to flat. So we're going to teach you how to trade volatility. And the same thing happened this week, folks, is Tuesday, people in the primary live trade brief said, Wiz, are you going to manage this? Or I'm like, I gave the exact same answer I gave Comey week. I said, folks, I'm not touching this trade. It's a hedge. I said, if I try and manage this trade or roll or do anything, I'm going to lose money. I said, with my luck, it's only Tuesday, folks. It expires Friday. With my luck, something's going to happen to freak this market out between now and Friday. I think I might change my call sign to Nostradamus. It happened that Thursday. Same thing happened this Tuesday. Same people asked the same question. I said, nope, with my luck, something's going to happen Thursday to freak the market the hell out. I am going to change my call sign to Nostradamus because that's pretty damn good, folks. What does Obama teachable moment mean? Gerald, it's slang, because Obama used to use that phrase every once in a while, like whether the cop up north, acted stupidly. I call them Obama teachable moments. He talked to us like he was our father, and teach us stuff. So it's a slang. Tanya, thanks, Wiz. Can you email the Wingman Group Coaching, or where on our website can you find it? Wow. Okay. Well, if you want to jump all the way to Wingman Group Coaching, hell, you can do it. You'd have to wait until the next one. I think Doug, correct me if I'm wrong, you just wrapped up one. Where at Tanya, you have to join Full Throttle first, and then we'll talk Wingman Group Coaching. Okay, so it's a gateway. Think of my SOT pyramid, strategic, operational, tactical. Think of TGO as Commanding Officers Club, Wingman Group Coaching, and Full Throttle. So Full Throttle is the entry to Top Gun Options. Then you can do Wingman Group Coaching, and then Doug and I can do one-on-one with you. No kidding, but that's very, very, it ain't cheap, folks. Our coaching runs anywhere from $300 to $600 an hour. So it's
It was just a second here. Hey, Tanya, join up with the program we have, and I'll get you on the list. And I do an interview with each person on the Wingman Group Coaching, so I'll get you on the list for the interviews for that. It'll be coming up in a few weeks here. So
correct.
Sorry to interrupt, Wiz, but there you go.
Yeah, so
There you go.
Tanya, you got to pick a full throttle slot, and then, like I said, after Doug gets done teaching his full throttle 8 sessions, you know, his 4-week stuff, we usually take a breather, and then maybe the following week or week after that, like I said, Doug interviews folks and to make sure that they're right for it, and he, you know, he picks and chooses and gets a nice tight squadron. You guys think we're a tight squadron now? The WYNN group coaching stuff is even tighter, and you get to work one-on-one with Doug. Okay, so make sure you grab one of the slots here, and then we can talk WYNN group coaching. You're welcome, Tanya. So, yep, grab one of your slots, defensive, offensive, or max. And obviously the best thing there is max. And I sent out an alert as Doug was talking on that VXX trade, guys. So it's pretty funny that happened. We got another Thursday where we got a missile out of the blue that can hit the market. It sucks that politics is driving this. It can drive this market. There's the sell the State of the Union. There's the Republican clown car idiots who can't repeal Obamacare. They own the House, the Senate, and the White House, and they can't repeal Obamacare. They've gone full retard. And then there's the Comey memo. And here's the Mueller memo. So, guys, you have got to, when vol is cheap, you buy it. When it's expensive, you sell it. It's hella cheap right now. I mean, right now it's still hella cheap, even with the spike. Because there's a lot of creepy stuff going on right now. And it's funny because I showed you this Wall Street Journal article, and I laughed even more because this guy's in Boca. It's funny, this guy, retail investor Jason Miller at his apartment building in Boca has been shorting the VIX. On days like today, people who are short VIX, they get obliterated. So the short VIX trade might have worked most of this year, but the times when you get a that, you get a that, you get a this or a this, you know, that they might not be the smartest guys in the room. And you guys know what are that? Markets take the escalator up and the elevator down. Volatility can spike 20, 30, 40% in the blink of an eye. So really happy with the VXX trade. Very, very happy with what's going on the whole week. The SPX bull put spread, the weekly that I put out on Monday, you could have closed Tuesday or Wednesday for a $1,400 gain. I said, get out of it. Pigs get slaughtered. It's up about 70, 80%. Get out. If you didn't, now you're looking a little, now you're smoking your lucky strike and going, oh, crap. By this afternoon. No oh craps here. Pigs get slaughtered. Get out of trades when we tell you to. Yes, here's the replay page, and then I got to go. And Doug and I, we got to get back to work and trading here. Here's the replay page where you can watch everything. I'll render this, and I'll get it up here on this page as soon as I can. Within about a half an hour, I'm going to grab some lunch sitting here, but I'll get it up on this page as soon as I can. But remember, guys, once we get to 50, we're gone. So between now and tomorrow, Doug will get out his everything he promised you to get out today. And then tomorrow we'll see at 1 o'clock for our debrief. And then I'm going to talk to you guys about weekly options, okay? So if there's no other questions, comments, concerns, or smart remarks, Doug and I are going to get back to work. You guys are going to grab one of your annual slots right here, defensive, offensive, or max, or you're going to give us a call. Somebody said they were on the road and couldn't get on the website or something like that. We can take a phone order and do it over the phone. 754-300-1084. Okay? Happy hunting. Make sure you hedge. God bless, guys. And Doug and I will see you for the final full throttle brief tomorrow at 1 o'clock. We'll see you.